Hello, fellow podcasters. Welcome to Astor Investment Management's podcast series. Today, Astor's CEO, Mr. Robert Stein, will be reviewing his Outlook 2020 article. Rob began his career as a project analyst for the Federal Reserve under former chairman Paul Volcker. Let's tune into his reflection where he discusses recent Fed activity, reviews 2019, and share his forward outlook on what's to come in 2020, touching on equities, inflation, the US dollar, and the diversified US economy as a whole.
Hi everyone, we're here today to discuss our 2020 economic outlook. Matt, did you take a look at that yet? What do you think?
I did. I thought it was great. I loved your opening line. Started off with stocks went up and we didn't have a recession.
Because that was the big concern as the year was ending in 2019. In fact, even Christmas Eve, people were looking at these markets wondering where the bottom is. And then all the people who were writing year-end pieces were speculating that we were going to have a recession in 2020. So I think summing it up by those two things, what happened with those two things, stocks went up and we didn't have a recession, kind of addresses what everybody was thinking at the end of the year. I mean, what was going on at your Christmas table?
I was about to say, Christmas Eve, I was literally sitting here in the office. I came in for a couple hours in the morning to wrap some stuff up, and I was looking at the market, which reached the bottom that day. And I was saying, what's happening? Is this going to lead into a recession?
And you weren't alone with that, I don't think. But fortunately, here at Astor, and you look at it as much as we do, the creators of it, have our Astor Economic Index to guide us. And what was concerning, Mac, was the economic index had been declining a little bit. Nothing that made us try and adjustments, but you know how you sometimes get ahead of the game. But fortuitously, the decline was minimal. And for us, what we've seen in the past is when stocks decline and economic data is not, especially how we measure it with the Astor Economic Index, we generally get a pretty decent rebound.
Yeah, and so we mentioned the Astor Economic Index a couple times. Before we get too much deeper into that, because that is the baseline of how we look at asset allocation at Astor, what we forecast, we don't forecast, but if we talk about expectation of stock returns. So can you go over real quick what the Astor Economic Index is?
Yeah, I think that's a good idea, Mac. I think the people listening probably want a little bit more detail on it, right? I know that you tell the story a lot as well, but the Astor Economic Index aggregates fundamental economic data. It looks at output data, employment data, and tries to assign it a value. And that value is very important to us because we make asset allocation decisions based on that value. But as you've seen and heard us talk, that value is calculated in a way that we think gives us an edge, because there's periods of time where you would look at something and say that's high or that's low because of the number, but it really isn't. There's periods of time where US GDP was in the high 3s, 4%, and now we're getting 2-ish, and there's periods of time where 2-ish is a high number, but it's all how you measure it relatively.
Right. So in summary, essentially the Astor Economic Index is our proprietary view of the U.S. economy, a temperature gauge.
Yeah, but a nowcast, right?
Nowcast.
It's how the temperature is today rather than telling you what the temperature is going to be 2 weeks from now.
So coming into 2019, ending 2019, coming to 2020, where was the Astor Economic Index and what caused it to, which you'll talk about in a second, decline?
Right, and I think it's important to get this out there to people because I'm going to say probably in the last 3, 4, 5 years, it had probably the most significant consistent changes. It can move 10 basis points one quarter and 10 the other, but I think it's been a long time since we've had sequential directional moves in the Astor Economic Index. So in the first quarter of 2019, the stock market recovered and the Astor Economic Index started to show its first declines of reducing beta. We're slow and gradual with those moves, but it was sort of the first reduction in beta that we had in a meaningful way. And then as the second quarter started to evolve, we saw further declines. And then by the end of the third quarter or somewhere during the third quarter, we got to our lowest risk portfolio we've had on in, what do you think?
A decade,
or at least
07,
7.
08, yeah.
But we haven't gone to the defensive area yet, but one of the lowest levels of beta. And, we were talking earlier that it's not a timing vehicle. And while the market rallied a little bit to slightly significantly at the end of the year in 2019, we still felt comfortable, and you were saying clients did as well, with the reduced risk in the portfolio. And we feel that way because as the economic data was beginning to and Mac, I don't want to say weaken, but not consistently strengthen as it had.
Moderated.
Moderate, yeah, I like that word. We think that things that you can't see happening could cause additional volatility in the market. So it isn't any one particular thing that was having the index roll over, but it was one particular thing that was having it stay strong, and that was employment. Right. And you hear about it and see it everywhere. Employment trends are strong, strong, strong. And of course, if you've read anything that we've put out, you know how important we think employment trends are. But manufacturing, ISM, a strike in General Motors, a lot of things were showing that the manufacturing component of the economy was starting to waver a little bit. And so we reduced the beta.
Yeah, so, I've had the chance to travel with you around the country as you speak in front of large groups. You kind of define two silos of economic data, right? You say there's employment data and there's manufacturing data. So you just said the manufacturing data has kind of pulled the index down a bit, and employment's kind of been the buoy to kind of keep it in that middle range, right? So the index is around average growth right now. So in terms of expected return of stocks, where would you say that the index is, the Astor Economic Index is saying stocks are going to go?
So average is still good for stocks. Equity markets still appreciate in average. And while I don't want to draw a direct correlation that the lower the economic index is in average, the more volatility you get and the return becomes less certain. But that's kind of what we're thinking. But the real thing, Mac, and I think it's important for investors, clients, and soon-to-be clients, the main purpose of moving the beta around to these levels when the economy is average is that average could slip into below average, or it could go to above average and accelerate. And so rather than having to make a decision with a big piece of your portfolio in a 1 week window, we're able to make a decision that will meaningfully impact the portfolio and not have to do as much as portfolios that are just waiting for a trigger.
Right, and we talked a lot, and I've heard you say, again, at different speaking engagements around the country, that the index, if the index cuts to a point where it's less healthy, right, or I think you've used the term less good, the data is coming out. It doesn't mean that the stocks necessarily we think they're going to go down, but the probability of the market being able to absorb some sort of shock becomes much less. Like in Q4 2018, the market is down 15% depending on what index you look at, but the economy showed no signs of weakness, right? So it bounced back pretty quick. We didn't sell, and we caught that bounce back. But when the index starts to drop and the economy becomes less good, to use your words, put that in another context for me.
Right. No, that's a great point. And, highlighting the fourth quarter of 2018, which, you don't often want to highlight periods where you had negative performance. But the point, Mac, that you're making is the confidence that we had that the portfolio or that the equity market would recover from that was much higher because of how the Astor Economic Index reading was, or how the strength in the economy what was being viewed. And so while Christmas Eve was stressful, it still felt good that at some point this too shall pass.
It wasn't going to drag down and turn to recession.
Correct. But as you get to more average readings, two things can occur. One, a more exaggerated market movement from something that might not have been a big deal, and we're seeing that. And if that thing that is a big deal or not a big deal that hits the market could be the tipping point of making an economy that's average go below average. Right. We're not going to go below average or have a recession because one of these factors. I don't think we've had anything in modern history that caused the recession, and even the horrific events of 9/11 didn't cause a recession. We were already having some weakness. And so that's the big point of being at average. Now something extraneous could create the slowdown.
Yeah, and so you mentioned the 2001 terrorist attacks that was on top of a weakening economy, which led to a recession.
Right.
More or less, right?
Yeah, and weakening, let's just say not growing as fast.
Yeah.
But no, in 2001, we were starting to get some negative data in the second and third quarter.
And that kind of, the end, or the title of your outlook was Party Like It's 1999. And then in the outlook, which you can find on our website at astorim.com/insights, you drew parallels to the market and the economy today versus 1999, 2000, 2001, which I found very interesting and a bit ominous considering it was right before a major recession.
It feels like it was much closer to a recession that occurred than it was, because when you look back at 20 years ago. But there were some interesting things occurring in 1999. We speak about it in the Outlook report, with how the Fed was adding liquidity to the markets then for fear of Y2K, adding liquidity into the markets in 2019 because of glitches in the overnight funding market. To me, sounded similar. I'm not the first to point out to the NASDAQ's acceleration comparatively, valuations, et cetera, and so those things started to line up. But Mac, as you were pointing out, the economy started to stall after the liquidity was sort of soaked up. Employment trends, which were strong in 98, 99, started to weaken, and GDP acceleration, and then we had these events. And so we are seeing some things. We talked about ISM and manufacturing that have gone below the average line, and it just seems very, very parallel in both scope and direction.
You know, Rob, you mentioned the liquidity that the Fed added in September, October of 2019.
Yeah, when the overnight markets were having
the repo market. Yeah. And you've written extensively about it on your blog, which again is at astorim.com/insights. I encourage all of our listeners to go read it, because what Rob was saying is people weren't calling it quantitative easing,
right?
But you were saying that it kind of was.
Right. I was unable to direct how this money was getting into the economy, and the Fed was very careful to not call it quantitative easing. They didn't want the unintended consequence, which they got, right? People rushing in to buy risk assets because rates were lower. I feel that if you're doing something but call it something different, you're still doing it. And it, to me, looked very much like quantitative easing. I do believe that liquidity got into the system, and that liquidity has been used to drive risk asset and stock prices higher.
Actually Q4, right? We saw a big lift at the end of the year.
You were talking about the parallel to 1999. Alan Greenspan was adding liquidity because he was worried about Y2K. And then they were supposed to have it be a short-term liquidity support. And for those of you who were around in 1999-2000, spoiler alert, nothing happened at midnight. And that liquidity, well, not nothing, I'm sure you had fun, Mac, nothing to the economy. But as that liquidity supposedly was repoed out of the market, it wasn't. The NASDAQ was flying up to make new highs in the first quarter of that year. And ironically, the NASDAQ was shooting up to make new highs in the first quarter of this year.
Right. So, Rob, you're mentioning a lot about Fed policy, what Greenspan was doing in 1999, and a lot of our listeners don't know that you actually worked for the Fed.
Yes, before Greenspan, there was a man named Paul Volcker.
May he rest in peace.
Yes, and I was at the Fed when he was the chairman.
Excellent. With that being said, Rob, Fed policy, interest rates, what do you think's happening in 2020?
Well, it does seem like interest rates are driving the show, and we talked a lot about the fourth quarter of 2018. And as we look back, I don't know if anybody knows exactly what was happening, but certainly interest rates and the opinion of which way they were going had a lot to do with influencing the market. So Powell has sat on one side and one side on the fence of whether they're going to lower rates or stay pat. And the markets are expecting rates to be lowered a couple of 3 times. He said he's going to be data dependent, but I think that the market is so far ahead of the Fed right now that it's a fait accompli, that they're going to have to lower rates. But Mac, a lot of analogies to antibiotics and penicillin and things of that nature. Lower rates have been the penicillin for many ailments of the economy over the last decade, and certainly in the last few years. It's definitely been an impact on driving direction. I fear that lowering rates in the wake of another financial disruption will not have the same outcome. So you ask me what I think about rates. They're clearly going to cut them. If the economy has some giant disruptions or hiccups, and the Fed decides to do a emergency rate cut, don't expect that emergency rate cut to be the immediate solution it's been in the past.
Because we're starting to get immune to it.
Yeah, it's like we're given rate cuts for garden variety economic hiccups.
Yeah, interesting. A lot of awesome information in the Outlook, right? We go over data comparisons between now and 20, 50 years ago. We talk about manufacturing, inflation. So again, I encourage you to go read it in its entirety to our listeners. But one thing you've said in your Outlook, and I've been hearing you say it a lot lately, is that we're becoming more efficient at becoming efficient.
Exactly. Yeah. And we see it around here. And, we certainly can talk about the economic data points, and we enjoy that. But, Mac, when you and I are talking or about to talk to some of our clients, I really enjoy the philosophical what's going on. We all can crunch data, and we do a real good job of it to come up with our AEI, but there's trends in the economy and in society that also have economic implications. And the ability to become more efficient allows for competition to be quicker. People who have an edge can lose that edge very, very quickly. I remember merchants not too long ago being a big deal that they could take a credit card. They put the sign on the window, and they had that ka-chunk machine. You want to sell something? By 5 o'clock today, you could download an app and have something on your iPhone, and now suddenly you have a merchant account.
It wasn't too long ago that taxis in Chicago wouldn't take credit cards. You had to ask when you got to the airport, like, do you take credit cards?
Right.
Like 5 years ago-ish.
Yeah, even that recent. But this is even a step where you can be in business tomorrow with a website and an ability to take payment.
Right.
And so that's just a very high-level example. But there's so many things that are happening quickly to become more efficient that I'm going to use this word, you millennial people, but disruptive technology. And the ability to disrupt old processes and economic viability with new technology and new efficiencies. So what's the implication of that? I think it makes competition higher, prices are driven down, maybe profit margins decline. So there's a lot of things, but we didn't touch on, we do here, inflation. We did touch about how low rates are. And I think if we can continue to be more efficient to become efficient, we will keep a cap on inflation even with rising wages.
Yeah, very interesting. So awesome. Thanks for listening. Again, you can go to our website and read the Outlook in its entirety.
Thanks, Mac. It's always great to share our views with our listeners and our investors. And feel free to reach out if you have any specific questions. Go to our website, you can find out how to contact us. And we'll see you soon.
To learn more about Astor Investment Management's research and strategies, please visit us on the web at www.astoram.com or stay up to date by following us on LinkedIn and Twitter. Our app is also available on the App Store and Google Play. Thank you. Astor Investment Management, LLC is a SEC-registered investment advisor. All information contained herein is for informational purposes only. This is not a solicitation to offer investment advice or services in any state where to do so would be unlawful. Analysis and research are provided for informational purposes only, not for trading or investing purposes. All opinions expressed are as of the date of publication and subject to change. They are not intended as investment recommendations.